everybody. Today we were talking about the Toro company, stock ticker TTC. So let's jump right into it. So in the 1 year they're down 31%. It's quite the decline. And in the 5 year they're up 20%. So nothing crazy. Definitely when we were up into the 111s it was a lot better, but at 80 it's pulled back recently. It's kind of stayed flat over the last 5 years, nothing crazy. And then in 10 year, wow, they are 381%. That is pretty high. I'm pretty sure that beats S&P 500. And so the PE forward is 19. That is pretty realistic, and their yield is right on par with S&P 500. They're a market cap of 8.34 billion, so kind of mid cap, nothing crazy. So once we covered that, let's jump into the business. So Toro, a lot of people know them for their lawn mowers and stuff, but they actually own a vast amount of subsidiaries and like different brands underneath the Toro umbrella. So I just kind of want to highlight some of them. So obviously you have the Toro brand. These are the most recognizable ones, I feel like. Uh, any Most of the lawnmowers you see, they're going to be Toro. They own a big market share. They have zero turns, stand behinds, walk behinds. Just a really popular lawnmower brand. But getting into these other brands that you may not be familiar with. So you have Boss Snowplow. These, for the summer job that I have, the snowplows use these. They're very popular. They also have the red, like iconic. They're the trademark, I guess, and I mean they're just pretty iconic. And then I didn't know this before, but they also make these big trenchers. These are pretty big, and surface miners. I think this is a small part of their business, but still, it's nice to see that they're diversified. And then this is their commercial business. It's called Xmark. This is just more for professionals and stuff like that. More durable, longer lasting, but definitely more expensive. And then this was their most recent acquisition. I'll talk about this later, but this is just another professional brand. Yeah, nothing crazy here. It's got a big following. They bought it for 400 million. We'll talk about more like that. I said, yeah, just another. They have, like I said, a wide amount of brands underneath them. And then another big part of their business is Ditch Witch. So this is just a vacuum excavator. Nothing crazy, but this is where they actually make a lot of stuff. Yeah, I mean you can see here, makes some big machinery. And so once we cover their brands and stuff, let's dive into more of the financials and the company. So Simply Safe Dividends gives them an 84, which means very safe. Their last dividend raise was 14%, so we love to see that. So right now I have a very, very small position. I have 4 shares. I bought this back, or added to it, back in I think March, and right now I feel like it's a good cost compared to the rest of the market. I mean, 1.5 dividend yield. We'll dive more into why I think it's a good deal later on. And so, I mean, look at this 20-year growth, 19% growth on the dividend in the last 20 years is pretty amazing. So with Toro, they are more tied to the macro environment and economy. So as you can see, their returns was minus 64%, while the S&P 500 was 55. So a little bit more volatile in a recession, and the recession's sales dipped about 20%, but they still were able to increase their dividend throughout that time, and they've increased the dividend for nearly 30 years. So that makes them a dividend aristocrat. I mean, just look at this growth. It's kind of exploded since 2013 and gone up. And then back to their 5-year averages. So right now they are above their 5-year average in dividend yield and below for their PE ratio, which we love to see. And they're also at the bottom of their 52-week range, which is really cool. And they're trading right in line with the industrial sector PE ratio, which we I feel like Toro's a better company than most out there, so paying a little bit of a premium, I don't think we have a problem with. And then their earnings per share ratio, nice, consistent, never going above 33, which is what we like to see. And they've been increasing that dividend mainly off these earnings per share. I mean, it's just consistent, keeps going up. And then the free cash flow I mean, it's not as consistent as the earnings per share, but I mean, I think that's fine. If you put more into capex, the free cash flow isn't that big of a concern, and then their free cash flow payout ratio kind of follows their free cash flow per share. And then their shares outstanding. One thing they do buy back shares. Which we love to see. Their share count went from 121 million to 108, so we love to see that. And their total sales in billion just keep going up. I mean, like clockwork. Return on equity is nice. Return on invested capital, 20%. And look at, I mean, 30, 40%. That's pretty amazing. Operating margin, it's gone down of recent with the materials cost, but I'm not too worried about that. And then we'll talk about more about their debt soon. So just circling back, so their 5-year growth rate at 11.6 is well above the S&P 500. And anything above double digits, I mean, we love to see. I think it's 29 years, not 18 years, but still, that we love to see companies that continue to pay out dividends. And then here's just another view of the revenue consistently going up. The reason I pulled this up too, the seasonality of, since their bread and butter is lawnmowers, you can see the seasonality of, they have big revenue jumps about the same time every year, which is as expected. I wanted to hop into their earnings report. I'm pretty sure this came out March 3rd, and I just wanted to highlight some of the main takeaways. So, as you can see, their top line growth, I mean, pretty good. 872 million to 932. That's what I'd like to see. The biggest thing, though, and the main reason I think that they're down, what was it, like 35% in the last year, is this cost of goods sold. You can see they ballooned from 557 all the way up to 632, and this is mostly because of raw goods and raw like materials costs of going up like in this inflationary environment. So you can see that, and that's reflected in their gross margins going from 36 all the way down to 32. I mean, it's nothing too alarming. It's just a couple headwinds with raw materials cost, and as you can see, their selling and general administrative expense went up a little. I think that's indicative of the times. And then, yeah, that's why you took a bit of a hit on the net earnings, and then the earnings per share, 66 cents. I don't think it's any of concern. It's just a little headwinds that the company faces. And then, but you do like to see down here, so their average weighted shares went from 108 million to 105. That's good because they're buying back shares, they're retiring them, and that's good for the shareholder. It's just another way to return capital to the shareholder. And then another thing I want to highlight, so their professional business actually is the biggest part of their operation. So you can see it's about a little over 2 times as much for professional than it is for the residential. And then cash and cash equivalents, nothing really crazy here. And then this is what I wanted to talk about. So with this acquisition of Spartan Mowers, they spent $401 million for it, as you can see from this business combinations. And then they actually need to take out $400 million of debt to fund this. So hopefully this pays out. I think it will. This is a very popular brand. They have about $200 million of sales per year. They have a cult-like following for their mowers. They're a very popular brand, so I'm not too worried about. I'm excited for them releasing this as like one of their products and subsidiaries. And so you had a decline in cash and cash equivalents to fund this, and they only 31 million for dividend stock, or to pay out their dividend, which is really nice. And then in that same period, they bought back 75 million, dollars of their own shares in this 3-month period. So it's good to see. With this big decline, you like to see companies capitalize that and then put their money on the sideline back into buying their own stock. That's good. So yeah, I mean that was the main takeaway from the earnings report. They gave guidance. The guidance was pretty good. It is, I think it was like 8% growth year over year, which is pretty good. Even though inflation's 8%, you still have to reward a company, I feel like, for 8%. I do not think that this huge sell-off of 35%, all just from a hiccup in earnings per share due to raw materials cost, is warranted. Um, and then that 1.5% dividend yield, even though I know it's pretty low, this thing's a compounding machine. Like we talked about, their dividend, 11% per year. That, even though it's not the highest, anything over double digits is really good. I like. And then, yeah, so I would add TTC to your stock buy list. Their earnings are coming up on June 2nd, so look out for that. And I'll see you guys in the next one. Peace.